So yeah, I think let's jump straight into it. So my name is Katakani Baloy. I am the co-founder and CEO of a business called the Spark Up Company, and essentially we are a consultancy working with small and medium enterprises around commercial strategy and tactical planning in order to get your business or service to market effectively. Now, in the agenda for today, we basically going to be talking around pricing strategy. So we want to talk about knowing your pricing basics. We are going to look at key pricing strategies that I'd recommend you guys consider. And then also we are going to be looking at pricing psychology 101. So just a couple of tricks that you can use to try and motivate your customers to actually buy into your proposition. Now, starting off with knowing our basics. The first key thing that you need to know around pricing has to do with your cost drivers. So essentially, understanding the things in your business that drive your costs. You need to have an idea of where your break-even point is sitting to make sure that you're profitable. You need to have an understanding of the product segment that you are operating in. You need to understand the sales environment where your customer is potentially going to transact in order to acquire your product or service. And then on basically bringing all of that together is about knowing your customer. Now, starting with that first one, the cost drivers. These are things such as advertising, raw materials. You can look at things such as packaging if you've got a product, any manufacturing processes, employees or staff, warehousing, logistics, office space, and in some instances, fuel expenses if that's the type of business that you're running. So essentially anything that adds a cost to running your business, or anything where you have to spend money in order to run your business. And by the way, very important, guys, this includes your time as well, because you need to be earning some sort of salary or profit from the business that you're running. So essentially, a great starting point when you are trying to work out your pricing is to make sure that you've got a clear view of every single cost driver in your business. So everything that is going to result in money leaving your business, make sure you've got a very clear list of that, and you've got a solid understanding of what those things are and what it is that happens in your business that makes those things go up, and what you can do to try and maintain those things as low as possible. Once you've got an understanding of your cost drivers in the business, what you then want to do is identify what your break even point. Now, in a sentence, essentially a break even point is the point where your revenue equals your expenses. So if you look at that graph that I've put there for you guys, you'll see the orange graph speaks to the costs. So those are the cost drivers that I mentioned. And the blue line speaks to your revenue. So essentially, these are the sales that you're able to generate in your business. What you want to try and work out with your break even point is if you had to take your revenue minus your costs, at what point does that calculation equal zero? And the reason it's important for you to understand that is because if you are pricing your product in such a way that your sales are essentially sitting below the break even point, you are going to be running at a loss, which means that you are constantly going to be subsidizing your business. So instead of you making profit from your business, you're the one that has to every month be putting money back into the business in order to keep it running. And that is really not a sustainable or desirable place to be in. What you ideally want to do is at the very least be breaking even, if not making some sort of profit. And pricing can be a key tool that you can use in terms of trying to achieve that. So very important to make sure that whatever you are pricing your product at, you've got a very good understanding of that break-even point. One thing that I'll point out for any entrepreneurs on the call who might be dealing with products that are consumer goods that are actually going into retailers, I mentioned quite a couple of things in the cost drivers. One key thing that a lot of small businesses aren't aware of when they are engaging with retailers is the fact that within your pricing, you also need to factor for things like any rebates that might need to be given to the retailer. So sometimes the retailer will say, if you are selling something for 100 Rand, there is a 10, 14, 20% rebate that they then take, and that then gets allocated to any warehousing costs they might incur for keeping your product or your stock. It might include any marketing that they might be doing, so if they're putting your product into leaflets, etc. And there's a whole bunch of rebates and commissions that get structured into your agreement. So make sure that when you are working out your break even points, you've also kept that in mind. Now, once you've done that, you then want to get an understanding of your product segment. So here you want to ask yourself a couple of questions. Am I selling a high-end, ultra premium product, or am I operating more in the value side of things? And the reason you want to think about this is if you are selling a premium product, chances of you pricing in such a way that you want to compete with your competitors is very low. So a Ferrari is going to be 4 million rand, regardless of what the economy is doing, regardless of what price Lamborghini has put on their cars, regardless of how the social sentiment in the particular market is, versus a brand like an Opel, where you are looking to get customers from a much broader base, people that are sort of in the lower to mid tiers of the market. For them, your pricing is going to have a big impact. So if you are priced, so say if Opel has priced their vehicles 100% higher than Nissan, as an example, customers are then going to opt for Nissan. Whereas a customer who's looking to buy a Ferrari, because they've got the money, it's not relevant whether a Ferrari costs twice the price of a Lamborghini. They just want a Ferrari, they've got the money, and they'll be willing to pay for it. So have a very clear understanding of what it is you are actually selling to your customer in terms of the segment that you're in, and make sure that you manage for that accordingly. The other thing is, the other consideration you want to look at is, are you looking at something that the customer is buying as a long-term investment? So something like a tailored suit that has been custom made for them, or are you looking at something that is more going to be like throwaway fashion? They can go into a Mr. Price, a Jet, whatever the story is, buy the product, know that they're going to wear it for 3 to 6 months. If the product fades, they'll just throw it away and buy another one. That will then also impact your sort of pricing. So a suit that you get custom made for you, you can probably, I know you'll pay upwards of 3 to 5,000 rand. Some custom suits you can probably even go up to around 20,000 rand for a full suit. Whereas you can walk into a Markham, for example, and buy a suit for 1,000 rand and it's a complete suit. But because of the mindset of the customer, you're not buying it necessarily as an investment or a long-term product. You want to wear it for that season because it's on trend, it's on fashion. You don't have that longer-term view to it. And so you can essentially structure your pricing in such a way that if you are offering some sort of premium value, in the sense that your customer will have your product for a longer period of time, you could look at potentially charging a premium for that sort of product. Then you want to be aware of your sales environment. So for those of you that are selling some sort of service or engaging with as in a business to business model, you trying to make a sale to someone that is sitting at a desk job doing their work is going to be very different to how you'll interact with that customer when they are on their coffee break, or if you take them out for lunch, right? Their mindset is going to be very different, and so the pricing conversation is going to differ based on the nature of your customer's business. Similarly, a customer that is standing in a Clicks that's thinking about health and beauty products, but she's there to buy products for her baby, is going to be in a very different mindset to a customer that's standing in a Clicks Baby, which is more of a destination for baby. They are going there thinking that they want to buy baby products. They'll probably spend a bit more time browsing. So you'll find that if you go and look at if you guys happen to be in Joburg in the Midrand area at Mall of Africa, they've got a Clicks on the one side and a Clicks Baby on the other side. If you go into those two stores and you compare the setup in terms of the baby department, you'll see in the Clicks environment, it's more about having your basics and your essentials. There isn't a whole lot of customer education going on in that space. Whereas if you go into the Clicks Baby environment, you'll see that they've got a lot of tent cards that have got information about the individual or products. It's more of an experience for the customer because the customer walked in looking for a destination shop to buy into their products. And so if you are dealing with the sort of product that is going to be living in a destination environment where the person knows that I'm going there specifically for this product and I'm going to have options, how you will then price in that environment will be very different to an environment where a person is just running through quickly. You'll probably want to structure your pricing so it catches their attention versus in a destination environment where you can be a bit more premium and not have to focus so much on discounts unless you're competing with a lot of other brands in the space. You also want to think about a customer who is buying from a convenience location like a spaza shop is going to be in a very different mindset to someone who's buying from a supermarket like a Pick and Pay or a ShopRite. And that person is also going to be in a very different mindset to someone who's buying at a wholesaler or a cash and carry like a macro or a jumbo cash and carry. And essentially, if you look at each of these three different customers, it might be exactly the same person, but the price of a loaf of bread, as an example, will be very different in a macro versus what it is at a spaza shop. Because when a customer is standing in a macro or a wholesale environment, they're thinking about bulk buying, and so they are trying to save, even if it's 2 or 3 rand on a loaf of bread. Versus someone who quickly runs to the garage or to a spaza shop looking for a loaf of bread, they aren't in a space where they are thinking, man, I'm prepared to drive 5-10 kilometers or spend 100 rand on traveling to a mall just so that I can buy a loaf of bread. And so you'll find that what ends up happening is that a loaf of bread in a macro will maybe be 15 rand, but when you go to a spaza shop or a garage, that same loaf of bread is maybe 19, 20, 21 rand. And so those sorts of things are things that you need to bear in mind when you are thinking about pricing your product. Is what sort of sales environment am I going to be selling my product or my service in? And then lastly, just to summarize everything, right? So all of the factors that I've spoken about now essentially go back to your customer. And essentially, it's really important for you to understand all of those key factors and keep them in mind when you are doing your pricing. You need to understand how they impact your customer and their decision making, and ultimately try and get inside the mind of your customer and understand when I'm trying to speak to Katakani as my customer and he is standing inside a macro, what are the things that he's thinking about? Okay, it's month end. He wants to do bulk buying. He wants to save money. So let me structure my pricing in such a way that I am highlighting the value of my product. If I am speaking to Katakani in an environment where he's at the garage and he's really there for the convenience, now it's not necessarily about saving money. I just want something that is convenient. So there, maybe your pricing isn't about a discount, but it's just about making sure that you're not necessarily double the price of everyone else that is on shelf, as an example. So very important. Understand all of these key factors and understand what they do to the mindset of your customer when they are deciding whether or not they are going to buy your product. Moving on to key pricing strategies. Now, there's a whole bunch of pricing strategies. If you guys go online and you search for different pricing strategies, you can probably find over 100 pricing strategies. What I've done here is I've given you the 4 key pricing strategies that most of the major retail chains and consumer goods companies like your Procter and Gamble, your Unilevers, etc., tend to deploy when they are working on their pricing. Now, the key tip that I would give to you here in terms of your pricing is that above all else, make sure that your pricing strategy meets your customers' value expectations. And what I mean by that is when your customer is at the point where they've seen your product, they've interacted with your service, they've got a good idea of what that product or service is going to do for them. And in their minds, they've created a certain number to say, okay, I value this product or this service at X amount. Make sure that whatever your pricing strategy is, it comes in either at X or below that. Because if you are coming in above that amount, then all of a sudden your customer is thinking, this is too expensive. And this holds true whether you are selling a chappy for 2 rand at the garage or you are trying to sell a 50 million rand house in the middle of Sandhurst. If you price your product, say the house in Sandhurst, if you price it at 50 million rand, or at 51 million rand instead of 50 million rand, those customers in that environment will think, I'm not willing to pay that extra million rand because the value that I've got in my mind for that particular product is sitting at 50 million rand. Same thing if someone walks in to your shop, and you are selling a chappy where everyone else in the market is selling it at 2 rand and you sell it at 5 rand. In their mind, they'll be thinking, nope, the value that I get from this product is worth 2 rand. I'm not going to pay that 5 rand. So make sure that whatever you are doing from a pricing strategy point of view, you are meeting your customers' value expectations. Now, the four key strategies that I'd like to discuss with you guys here today, and I'll go into a little bit of detail around them. The first one is what's referred to as EDLP, so that's everyday low pricing. And essentially, there you are saying in your customer's mind, if you are looking for the lowest price for this product or service, I'm the person that you come to. The second is perception based pricing, and this speaks to what sort of perception are you trying to create around your product in the mind of the customer. The third is index pricing. And essentially, here, what you're doing is you are picking a competitor in the market and you're pricing based on what their pricing looks like. And then the last strategy is cost plus pricing, where essentially you are figuring out all of those cost drivers that we spoke about at the beginning of the session, saying these are the costs that I need to factor for. This is what the cost per unit is for me in order to deliver. And this can be the product itself if you are selling a physical product, or it can be the man hours if you are selling some sort of a service. And then what you do is you plus to whatever that cost is the profit margin that you are looking to make. Now, to give you just examples of what this is, everyday low pricing is something that is practiced in the South African market primarily by retailers like Game, Shoprite, Usave, Boxer, etc. Where a great example of this was Game, where they've got in their policies a guarantee that says if you go out and you buy a product and you find it cheaper anywhere outside of Game, what Game will do is then match the price of that product. And I believe at some point they were saying we'll match it, and then we'll also pay you whatever the difference is in terms of the pricing that they had versus what you actually went out and purchased that product for. So essentially, this is a strategy that you will deploy if you have some sort of product that is a necessity or it's a basic that your customer keeps coming back for month on month, week on week. This could work out really well for you because what it does is it trains the customer almost to come back to you every time they run out of soap. They know that they are going to come back to the shop, look for your soap product because in their minds it's giving them the best value. Then we've got perception-based pricing. In a nutshell, perception-based pricing speaks to when your customer looks at your product and then they look at your pricing. What do you want your pricing to say about your product? Do you want customers to look at the pricing and think, okay, this price is cheap compared to everything else, therefore this is maybe a value product or it's a low-cost product and I'm buying it because I'm working with a budget? Or do you want to have your customer look at your product and think, okay, this is a premium product, so obviously the performance is going to be better than everything else that I'm seeing on the market, and that then becomes a selling point for you. So all of these things on a subconscious level, people aren't necessarily always conscious and thinking about these things, but when someone is standing at a shelf and looking at these things subconsciously, this is what's going through their minds. And to give you an example of this, a VW Polo back in 2009 was around 100,000 Rand. A Mercedes-Benz C200 in 2009 was around 300,000 Rand. So Mercedes wanted to be premium to the VW brand. So rather than pricing their product at 120,000 Rand, they went and priced it 3 times the value of what the VW product was. Yes, they were selling a better product, but they also wanted that to be clear in the minds of the customer to say, listen, my C200 is worth 300,000 Rand versus a Polo that's worth 100,000 Rand. So obviously I'm getting 300,000 Rands more worth of performance. You fast forward then to the current year, 2022, what happened around that 2009 period was that there were a lot of cars coming in from Asia, a lot of these cheaper products coming in from Asia, and they were priced around the 80 to 90,000 Rand mark. So VW then went and said, if you look at those products, a lot of them, when they were coming in, were inferior quality. They didn't have airbags, the interiors were really terrible, the handling and the power weren't great. And so VW said, hang on a second, we are making a product that's more premium to this. Yes, we could be the best value in that segment, but if we keep our pricing at that point, in the minds of the customer, they are then going to start associating us with that inferior quality. So what did they do? They started improving the product a bit more, and then also with those small improvements in the product, they also increased quite drastically the pricing, where now a entry level Polo is sitting just under 400,000 Rand. And that was so that they could drive that premium view in the minds of customers. Mercedes, of course, then said, guys, we can't be priced at the same price as a Polo. Their pricing has also gone up quite significantly. The most recent C200 is starting off at around 900,000 Rand for that product. And just to demonstrate to you that, yes, there's inflation and whatnot that factors into this, that wasn't the only consideration. If you look at the inflation that's taken place from January 2009, if they were working purely based on inflation, a Polo would be sitting at around 200,000 Rand today, and a C200 would be sitting at around 600,000 Rand today. But because the perception in the minds of the customers is so important, you see that then reflected in the pricing as well. So bear that in mind when you're pricing your product and what that price says about your product. Next up is index pricing. And essentially here is where you pick a product or a competitor and you benchmark against them, right? So Coca-Cola and Pepsi, you'll probably find that one, I'm not sure which one of the two, but one of them sees themselves as a more premium product than the other. And so what they'll do is if Coca-Cola is selling their product at 10 Rand and Pepsi sees themselves as a premium product, they'll sell at 110%. So if a can of Coke is 10 Rand, a can of Pepsi will then be 11 Rand. And essentially, as Coke's prices go up and down, Pepsi's prices will also go up and down, staying within that margin of percentage. Then you've got cost plus pricing. Now, this is where you ask the question, where's my calculator? So essentially, you add up all of your cost drivers, you decide what sort of profit margin you are looking to make on that product, and then you base your pricing on that. So if everything going into your product costs you 100 Rand to manufacture and deliver, and then you're saying you want to make a 40% margin, you'll take 100, add 40%, so you'll sell your product at 140 Rand. Similarly, you can do the same thing for your services, but then obviously working with hours instead of a physical product. Now, jumping into pricing psychology. Now, again, I apologize for rushing through this. I want to try and respect people's time, knowing that some of you probably need to hop off at 10:30. But essentially, this is just a couple of tricks of the trade that you guys can use when you are putting together your pricing. And a couple of things that you can look at in here is number one, anchor pricing. The second is threshold pricing. You can then also do bundles and combos. You can also look at doing loss leading products. And let me quickly explain to you what each of these are. So anchor pricing basically works as follows. Say now I've got these two shirts that I want to sell to you at 800 Rand. You're probably sitting there thinking, man, 400 Rand for a t-shirt, that's expensive. It doesn't make sense for me to buy that. But if I now put another shirt next to it where I say, if you will buy only one of these shirts, you'll pay 650. Now in your mind, you're thinking, hang on a second, if I'm getting one for 650 and two for 800, I'm saving 500 Rand. All of a sudden, that 400 Rand per t-shirt doesn't seem all that expensive. Now, just to further drive this point home, I can then come to you and say, you can buy 3 shirts for 1,350. So that then takes the price per shirt up to 450. It's still a discount from that original 650, but it's more expensive than that one in the middle. So all of a sudden now, a customer is thinking, hang on a second, it actually makes sense for me to buy these 2 shirts because I'm getting a great deal. So essentially what you've done is you've created an anchor in the mind of a customer at that 650 price point. And now, instead of looking at the value that they are getting at 400 Rand a shirt, what they've anchored their benchmarking against is that 650, and obviously 650 compared to 400, the 400 seems like a better deal. So you are then able to use that to navigate your customer towards the products that you actually want to buy. You can do this with a same product where you are doing multiple versions of that product, or you can do it if you've got a portfolio of different products, say at different sizes. If you're selling something that's 100 mil versus 500 mil versus a liter, if you want to drive sales of the 500 mil, you would use a similar sort of strategy or tactic there. Next up is threshold pricing, and this is basically, you guys have seen that thing where something is priced at 10 Rand 99 instead of 11 Rand. That is so that you are not breaking that pricing threshold in the mind of a customer. And as I mentioned to you guys, you're applying the same strategies whether you're selling a piece of chewing gum for 2 Rand or you're selling a 50 million Rand house in the middle of Sandhurst. This particular one is selling for the ridiculous price of only 49 million Rand, 999,000 Rand. That's essentially 1,000 Rand cheaper than 50 million Rand. But if they were to write 50 million Rand on that price tag, in the minds of a potential customer, someone is thinking, well, I bought a house for 40 something million Rand versus buying a house for 50 million Rand. That all of a sudden feels big, but in reality, it's only 1,000 Rand difference. And what's 1,000 Rand when you're spending 50 million Rand anyway? So bear that in mind. It's nice to have prices that are rounded off. It makes it easy for you to track your business, but it also makes it very easy for a customer to decide, that product is too expensive. Whereas if you'd literally taken off 1 cent and made something 9 Rand 99 instead of 10 Rand, you likely would have closed that transaction. So keep that in mind when you are setting your prices. Then we've got bundles and combo pricing. So essentially, where you structure your pricing in such a way that, similar to that anchor pricing, where you are saying to someone, listen, buy 2 products and get the cheapest one free, or buy 3 products and we'll give you one of them for free. Or if you buy 2, you're buying 2 for 30 Rand instead of buying 1 for 20 Rand, and you are saving 16% on that particular product. You see this across essentially all of the retailers, and it's a key strategy that a lot of these retailers do to try and drive volume. So bear that in mind when you are putting together your pricing. It's stuff that you can also use. It doesn't have, your product or service doesn't have to be on a retail shelf for you to employ the same pricing tactics and strategies that the major guys are using. And then lastly, just to wrap up, the last pricing strategy or pricing tactic that you could look at is loss leading. Essentially, loss leading is where you do things or you sell products to your customers that cost you time, resources, and profit. An example of loss leading would be something like running this workshop, which I'm running for free. And the idea is to try and drive visibility and traffic to some of the services that I'm offering around the commercial strategy, with the idea is that potential clients such as yourselves would then see the value of this work and then want to engage further and maybe reach out to me on the details that are on the screen there. At a high level, that is essentially a nice starting point, I think, for you guys to kick off your thinking and your discussions around pricing strategies for your specific business. I will share this document. I'll just ask Dashan to please share everyone's email addresses with me so I can share this presentation with you so you can use offline as well. But essentially, that brings us to the end of this session.